Out of context, facts and figures can easily mislead. Is Africa's growing population a weakness? What about tomorrow? Don't get boxed in by today's opinions. With the Africa Report, understand Africa's tomorrow today. Politics, business, opinion, the Africa Report decodes the news for you. Available online on theafricareport.com.
Ladies and gentlemen, welcome to Renaissance Capital's 25th anniversary. It's a remarkably good week, I think, for us to be holding this conference because I think it's the good times are back for emerging markets. Emerging markets obviously had a long history, and Dan's done some great work on that. Dan Salter, our equity strategist, he'll be speaking a little bit later in this session. After I've given an overview on what I think are the big themes that are coming out of the US presidential election. Renaissance Capital, as you probably know, started 25 years ago, set up by some bankers, Western bankers and some Russian colleagues who decided that if you could produce the best research possible, maybe investors would take a risk on emerging markets. And that theme has been driving, I think, our ethos all of this time. I also started in emerging markets about 25 years ago. It was just as the Mexican peso crisis began to unfold. And I've seen an awful lot of those crises over the last 25 years. The last 10 has been pretty tough for emerging market investors. And I'm going to go into some of those reasons here. A couple of things I wanted to mention. There's a comments box. We are going to take questions. So if you can put some questions into the comments box, then Dan and I will try and address those at the end of the presentation. So let's start off with the US election itself. In May, we put out a report that looked at the history of US presidential elections over the last 100 years. And the message was pretty categoric, that if there's a recession in the last 2 years of a president's first term, he gets the blame for it. Whether it's right or wrong, he gets the blame and loses that election. And my assumption was that Trump would lose. I didn't base that on opinion polls because I didn't really trust opinion polls after 2016. It was just on this 100 years of history. And that, I think, is what has happened this last week. That the voters have taken against the unemployment and against the recession. What does this imply for what comes next? It tells us that Biden's going to get re-elected in 2024, assuming he runs. So we don't have to spend terribly much time focusing on how the Republican Party deals with this defeat, because the Democrats are going to be there for 8 years if Biden runs again. If they change and decide that Harris should run, well, then I'll be a little less certain about what happens in 2024. And of course, if there's a recession in 2023 or 2024, then my view is going to change. The Republicans will be back. But why is this so important? Normally, I don't pay so much attention to a US election because emerging markets have got their own themes and stories. But what has been going on with Trump has really mattered. And it's mattered, and what we put out in May was because of this graph, which I've updated just with that last column on the right-hand side just a couple of days ago. What this is showing you is foreign direct investment flows. The blue line, the blue column, is how much American investment has gone abroad. And the last time we had a really big bull run in EM was in the 2000s, when you see the figures getting up to $400 billion a year of American FDI flowing offshore. At the same time, the orange column is how much foreign direct investment went into America. And the last time there was a bull run for EM, you can see that the blue column is quite a lot bigger than the orange column. And the gray line there along the bottom is trying to show you what the net of those two numbers was. And you were seeing outflows from the US to the rest of the world worth hundreds of billions of dollars when George W. Bush was president, and indeed when Barack Obama was in his first term as well. But in the last 4 years, it's been a complete turnaround and a huge inflow of dollars back to America, because Trump gave a tax incentive to US companies to bring money back in 2018, open-ended tax cut, by the way. And I think that foreign investors in Europe and Japan feared that Trump was going to take his trade wars that were happening so obviously on China and spread them to other countries. I think that risk has been obvious for a couple of years now. You've seen the Germans be threatened by Trump. He's had a go at Korea, Mexico at the beginning of his term. I think emerging markets have suffered as a result. If you're a German car company, you don't want to build up your output in cheap South Africa. You want to build up your car output in South Carolina, because you can't be sure that Trump wasn't going to impose tariffs on Europe at some point. So I think this has contributed to companies deciding that America was the safest place to be, even though the minimum wage is $1,253 in June, we think, in the States, and more like $100 or $200 in many of the emerging and frontier markets we look at. And the Europeans and the Japanese, I think, were making the same decision. So you had FDI trends that I think contributed to this dollar strengthening trend in the last few years. And I think after nearly 10 years now of dollar strengthening against the euro, I think this election is a good enough reason to think that trend's going to change. So what's been happening for the last 10 years is, if you've invested in emerging markets, you've probably lost a few percent each year on the currency. And what I think is going to happen is you will gain a few percent each year if you invest in EM for the next 5 years or so. I don't think we're going to go back to like $150 euro, which is what we saw on the synthetic dollar euro back in 1979, 1980, what we saw again in 92, 93, what we saw again in 2008. I'm not talking about that. I'm just suggesting we might be heading towards 125, 130, and you get that gradual support. It's not just going to be foreign direct investment flows, though. What we've been assuming for the last few years is that when the next recession came to developed markets, you're going to see a massive ramping up of public debt ratios in the West, akin to what happened in Japan after 1990. And the consequence of that was likely to be a fall in yields on government debt. Now this chart, which includes the chart crime I've mentioned to you a few times of different scales on the left and right, is just highlighting what I think's been happening for the last 10 years, which is that Germany in red has been tracking Japan and will continue to do so. 0 to negative yields, I think, on Germany are likely for the next decade. And that's going to keep US Treasury yields capped as well. I don't think US Treasuries are going to go much above 2% in the next 10 years. I think 0 to 2, that's my assumption for where US bond yields are going to be. So I think American portfolio investors, not just the foreign direct investors now, but the portfolio investors are also going to be saying, where can I get yield? And they're going to be pouring their money, I think, into emerging markets. What we've seen on dollar debt of emerging markets is yields 20 years ago were, what, 12%. 10 years ago was 6%. Today they're 4% on mainstream emerging markets. And I think there's a good case to assume that they're going to fall to 2.5%, 3% over the next 10 years. If you can pick up 4% yield now versus sub 1% in the States, I think portfolio money is going to come to EM. In fact, we saw BlackRock's chief investment officer, the guy in charge of fixed income, in charge of what, $2 trillion worth of assets, saying on Thursday he wants to go overweight. He is going overweight EM. We've seen one of our rivals, a little bank called JP Morgan, say that they're going overweight emerging markets this morning. So I think this bid for yield is going to come in a big way. And by the way, I think the lower debt servicing costs that comes about because of this means that actually emerging markets can borrow more than they've ever borrowed before. So the ability to drive faster growth on the back of this debt, I think, is going to be much higher. And it's not just dollar bond yields that are so low. Local currency bond yields have also dropped. Now, this is another theme that we've been talking about. We put out a report in June or July about it. And the question I've been wondering about for the last couple of years is the disinflation wave that we've seen in the US since 1980, and which spread into Asia and then Central Europe in the last 20 years. I've been wondering whether that was then going to spread into mainstream emerging markets like Russia, Brazil, Mexico, South Africa. Turkey's the one exception, and the disaster that's happening in Turkey kind of in the last few weeks, I think is, it tells us we were right to be cautious in the summer about Turkey. But for mainstream emerging markets, we've now got the lowest interest rates in 200 years in Brazil, since independence, and the lowest interest rates ever in Russia as well. So this obviously has big impact on equity valuations then too. We're already seeing it in the States. Why is the US stock market, the red line here, since COVID, why is it already over its pre-crisis peak? And obviously it's Fed being very helpful on the monetary side. It's Congress has been helpful on the fiscal side. But I think fundamentally it's these really low interest rates mean that you can afford and should be justifying higher equity valuations. And it's not just the US that I think this is going to apply to. I think this is going to apply to EM as well. Now, a different way of looking at the FX story is this chart of emerging market foreign exchange weighted, but excluding China, which is its own story. And you can see that the EMFX did have this fantastic bull run from 03 to 2011-12. Again, I don't think we're going to have as good a bull run as we did in the 2000s. I don't think dollar euro is going to 150, or at least I don't have any good reason to suggest that now. And we haven't seen EMFX get as cheap in the last few years as it did after the Asian crisis and all the trouble that happened in the late 90s. But I do think there's a decent case to assume that EMFX, because you still get some yield, even if it's lower than it was, you still get some yield. EMFX is going to do better. Normally, the weaker dollar is great for commodities. I'm less sure about the oil price, however, because I don't think euro-dollar, I don't see a good reason yet for us to think about 150. I also don't see a good reason yet for us to think that oil is going to go to $100, $150. Obviously, there's massive upside surprise from here, potential. But I do think that a weaker dollar is going to encourage the oil price to go up somewhat. And that should then be helpful. So I think it's going to be helpful, but it's not going to be massive. And I think that's partly because of this carbon emissions story. Dan and I put out our ESG reports in late 2018, looking at environmental social governance issues and focusing a little bit on this issue of carbon emissions needing to be zero on this chart and being anything but zero. So I think we are going to see carbon taxing in Europe and more pressure from that side, which I suspect is going to suppress oil and gas. But just chat to our oil and gas analyst, Sasha Bagansky, and he will explain to you why Russia, as one of the cheapest producers of oil and gas in the world, will be one of the last people standing on that issue. If there's one area that I think we could see some upside surprise more obviously is on metals, possibly kind of copper and steel and so on. And it's connected to the top left chart there, which is China's dollar GDP. I sent you an email a couple of weeks ago saying I think the IMF has got its China dollar GDP figures wrong. They then corrected them that very night. What I think the blue column is trying to show you is how big a rise in China dollar GDP we're going to get in the next couple of years, way in excess of anything we've seen before. As trade war risk with China goes down, I'm not saying that the US and China are going to be best pals. I don't think they will. But nonetheless, I don't think the trade wars are going to intensify. As trade risk goes down, I think the Chinese can let their currency strengthen. In dollar GDP terms, it's going to really lift China's economy. And that's been consistent with big rises in demand for commodities and the price of commodities in the past. We saw it in 2017-18. We saw it obviously in the 2000s. I think we'll see it again over the next 1 to 2 years. Again, it supports oil and gas somewhat. I think it could support metals even more. Which emerging markets are going to do really great from this? Well, the easiest, quickest way to express a view is via the FX market. And the emerging market with the most traded currency as a percentage of its own GDP, so the one that tends to move the most, is South Africa. 20% of its GDP is traded every day in the FX market. I think trade flows justify maybe 0.1% of GDP being traded every day. This is vastly more than that because it's a liquid proxy. And we have seen the South African rand rally massively in the last few days. I write off Hungary and Czech for now because of their virus issues, but Mexico is the other obvious currency, and that's also done well. Overall, when we look at emerging markets, this is our real effective exchange rate table that I've sent you many times. The fifth column along is the important one, the long-term average rate divided by the current rate. You've got China there. The model says it's 20% overvalued. What I'm saying is that the currency strengthened more than inflation would, kind of differentials would justify. But we always cross-check that against the current account. If the current account is in surplus, as it is in China. And people are suggesting that the IMF, if anything, are understating the numbers we've put here for the current account. It's going to be even better for China than these numbers suggest, of a surplus of 0.5% of GDP. What this is telling us is that China's economy has changed massively over 25 years. They've appreciated the currency, but it hasn't hurt their current account. And I think that's because of their productivity gains, which have been so significant. They used to make cheap plastic toys, and now my son wants a Chinese-made telephone for Christmas rather than a Samsung or an Apple. I'm too old school to join him in that revolutionary shift. So I think China's moved up the value-added curve dramatically. I'm not worried about that currency being overvalued. Where I think the real value is right now is down at the bottom of this table. Not the complete bottom. Let's focus on South Africa or Mexico, Colombia, Brazil. Currencies that are, in South Africa's case, 12% cheap. Mexico, 14% cheap this morning. Brazil, 24% cheap. I think as portfolio money goes into EM in the next few months, the ETF aspect of that is going to lift the weakest credits. And we could see the biggest return if you take the highest risk. And I guess that's where my suggestion would be for those who want to take a bit of a riskier approach to investing in the next few months. I think active managers, at least in our EMEA space, are going to worry a little bit about a Russia or a Turkey because of geopolitics and how Biden might approach Russia and or Turkey. So South Africa might end up actually being a beneficiary from that angle as well. Where else are we looking at? This is just a way of trying to work out how often currencies are very cheap or very strong on this model and where the gains could be. I'm not sure it's sending a hugely strong signal on any of them right now. You look at a country like Turkey, it's 16% of the time in the last 25 years, it's been more than 20% cheap. It doesn't tell me that that's going to disappear anytime soon. In fact, I don't think it does, unless we get an incredible best case scenario where the change of central bank governor and the change of finance minister gives us an IMF deal. I'm just not that confident we're going to get that. In which case you would see the lira rally perhaps back to 7 to the dollar. I think there's others that you could feel a little bit more comfortable being in. And South African Rand, I suspect, is probably one of them. In Frontier, when I was looking at this morning, you've got your stories like Vietnam, apparently overvalued, but I think it's like China. I think it's moved up the value-added curve dramatically over 25 years. I think that current account surplus that you can see in the 7th column along is telling you it's changed. I'm not worried about that currency getting weaker. The one that interests me today is Kazakhstan, 21% cheap on this model, a currency that should be stronger. And I know I've been saying this for a few years. And when we look at how often is it more than 20% cheap, just 1% of the time in the last 25 years has the tenge been this cheap on our model. So I'm quite bullish there. And I'm not just saying that because we did the Caspi IPO a month or two ago. Africa is a bit of a different story. And here I need to kind of start to focus on where some of the risks are for investors. And it's associated with the debt that's been taken on, the debt default that's unfolding in places like Zambia. And so when we look at this model of currency overvaluation and undervaluation, I think this is the thing to bear in mind or to keep in mind. So some of the countries that I think are most interesting on the dollar bond yield side, like Zambia, Ghana, Angola, also the cheapest you can see on our FX model for good reason, because default is unfolding in Zambia and people are quite worried about it for understandable reasons in Ghana and Angola. And again, the currency noise is not sending a strong signal here that we're going to see, that we should assume a massive rebound. Zambia's currency has been this cheap, more than 20% undervalued, 34% of the time. That's 7 years, 8 years out of the last 25 years. So it may well stay extremely cheap for quite a long time, even if copper prices are going up as they are. And what I think is driving this is that report we put out last year. The longer I've been doing this job, the more I'm tending to focus on the longer term drivers for emerging markets. Dan did a fantastic report on the middle income trap in 2015-16, I think it was, looking at why Russia, Mexico, Brazil, and Turkey haven't converged in per capita GDP terms anyway, like Korea or Taiwan have. And I've been spending a bit more time focusing on the lower income countries. And the piece that caught my attention last year was demographics and highlighting that where countries have very high fertility rates, countries like Nigeria, Angola in dark brown on this map, their interest rates and borrowing costs tend to be much, much higher than the countries in light green in Asia, top right-hand corner, or North Africa, to take Morocco as an example. And this is associated because the link here is that when you've got high fertility, like Angola or Nigeria on the right-hand side of those blue columns, 5 to 6 kids per woman, your banking system tends to be very small. And what that means is you've got a shortage of savings. That means you are tempted to go out and borrow a lot from abroad, especially when those yields are coming down, as I think will continue to happen for some time to come. The way out of the high interest rate story is to run a current account surplus. It's what East Asia did in the 50s, 60s, and 70s, 80s, and so on. And it's what countries like Angola and Zambia actually the fertility story here, which has driven up it's kept interest rates high, has encouraged countries to take on too much debt, and I do worry we're going to see some defaults beyond just Zambia. I'll try and sum that up again at the end. I haven't mentioned the virus at all in a presentation on 2020. That's pretty remarkable. I'm just feeding back here to a slide that we sent out in April, looking at how bad has the virus really been for countries, or how bad would it be? And what I was trying to highlight was, based on the case fatality rate that we had early in the year, we were guessing that if 20% of every country in the world got the virus, how many weeks worth of extra deaths would that cause? And the orange countries are developed markets, mostly on the left. African countries are on the right there in green. We've got CIS countries, including Russia, Kazakhstan, Belarus, in yellow. And our point then was that yes, this was going to hurt developed markets. And yes, this helped explain strong, stringent lockdowns. But emerging markets in blue, CIS countries in yellow, and African countries particularly in green, were likely to see maybe a week or two of extra deaths, even if 20% of the country got COVID. Now, this model hasn't been perfect. If you go to Latin America, in places like Peru, and this is now over a month old, this chart, I'm sorry, but Peru is like, they've had extra deaths worth nearly 20% of a normal year's worth of deaths, an extra 10 weeks, which is considerably more than our model suggested. But it's still hinting to us that we're not seeing the numbers come through in most low-income emerging markets or frontier to suggest that we're going to get strong lockdowns. And I think we're just getting that confirmed. Even in Pakistan this morning, they're sending some public sector workers home to work from home, and they're trying to encourage mask use and all the rest, but they're not saying full lockdown again. Lockdowns generally didn't work in low-income EM. So the base case we've got at the moment is that you've got emerging markets in East Asia, which is 2/3 of the index, which have successfully suppressed the virus. We've got another chunk of EM and frontier in low-income countries where the virus isn't having a terrible impact on lives sufficient for governments to feel that lockdown was justified. So again, I think there's also a shorter term, 3 to 6 month reason to be more enthusiastic about emerging markets right now. We know developed markets are going to get hit again, are being hit again through second wave, and are getting hit again by the lockdown. But emerging markets are looking somewhat better. I'm just on a little focus. In Africa, it's surprising to see countries like Morocco now actually seeing the most cases. Again, this chart's a couple of weeks old, and much more than we're seeing in sub-Sahara. And on the right-hand side, we are seeing that second wave start to impact on death rates in developed markets. But this last chart on the virus is just highlighting here that when we look at how many deaths we'd seen as of 2 weeks ago anyway, in a number of African countries, I think the worst hit has been South Africa, where deaths are an extra 3% above normal, which if it wasn't for the news focus on COVID, I don't think any of us would have noticed in terms of the data. And for many countries we look at, it's 0%. Okay, so risks and policy changes. I don't really change this slide most years. Every year we talk about shocks from global pandemics. I never expected what to me was the black swan event, which was lockdowns. Pandemic wasn't a surprise. Lockdowns was a surprise. And some of these risks are omnipresent. But one last one I would like to mention is regime change shifts, particularly for some of the oil exporting countries, whether it's been Algeria, where you've seen some political change in the last year or two. Iran, it's been a constant risk. There's more pressure on a country like Saudi, Fitch has just put it onto negative outlook this morning, its rating. I think it's tougher for oil exporters in this environment. So there is some political risk issues to keep at the back of your mind. But big picture, as far as I'm concerned, is this recession, the change of US president, the likelihood that trade wars lessen, that America may have issues with China, but it won't have issues with Korea and Europe, not in the same way. I don't think Biden's going to go after his allies in a way that Trump did. I think we're going to see net FDIs stop flowing to America in 2021 already. And by 2022, I think net FDI flows are going to be starting to flow out of America to the rest of the world. I think portfolio flows are going to find the yield that EM has to offer. And I think that's going to contribute to EM FX appreciation, which means it becomes a self-reinforcing trade. The more money that comes into EM, the better the currencies do, the better your performance is, the more money you raise next year, the more money you put into EM, currencies appreciate, and it becomes a helpful self-reinforcing trend. For Frontier in Africa, I think this cheap borrowing costs offer a fantastic opportunity for countries to borrow and invest in the infrastructure which they have to get right now if they're going to industrialize. 2017, we said education was largely sorted for most countries. 2018, we said electricity was most definitely not largely sorted for most countries. We need to see money being invested into electricity so that Kenya, East Africa, Ghana, well, Ghana's there actually, but others can start to industrialize. The risk is that they take on a bit too much. And we are going to see some debt defaults, and that's not going to disappear as a theme in the 2020s. And then lastly, even in the short term, not just this big picture story, but even in the short term, I think EM economies are going to be showing some outperformance relative to DM in coming months, thanks to the fact that COVID just isn't having as negative effect on these countries. Hopefully I've raised a question or two for you. If I haven't in my presentation, I would hope that Dan's presentation now does give you the chance to look at this as well and to ask a few questions. So I'm now going to hand over to Dan Salter to take us through the equity strategy side of the story. Dan, over to you.
Thank you very much, Charlie. Good afternoon and good morning, everyone. I'd like to take you through a few slides with slightly more of an equity angle this morning. So firstly, where are we now in the emerging market equity rebound? The bounce in emerging markets has been going on now for 33 weeks since the lows on the 23rd of March. We're now up 55% from the lows. And actually, if you rebase that against the other four big crashes that EM has had in the subsequent rebounds, so the 98, 2001, 2008, and 2016 crashes and their rebounds, the average at this point is 52% up. So 55% actually looks pretty much on the face of it where we should be at this point in the rebound. However, it's actually much more impressive than that, clearly. And we are now seeing that EM has just pushed through its pre-crisis peak in dollar terms. That is something that typically takes several years to accomplish. So this is clearly an impressive rebound, a very rapid turnaround, much more fast than usual, propelled quite clearly by the record amount of global stimulus which has been out there. You can see here, this graph looks at where we are versus the pre-crisis peak, that it's not just EM, but also many global indices which are now tracking above their first quarter levels. That includes the US, emerging markets, developed markets, and emerging Asia. But still, you can see there are pockets out there which have not rebounded fully. EM ex China still 8% below its dollar peak, Frontier 12% below, EMEA 20% below, and Latin America 30% below its pre-crisis peak. So you can see here that if you look at performance versus the first quarter peak within emerging markets, that it's really been driven by what I call the East Asian trio. You've got China, Taiwan, and Korea all up 10 to 20% above their first quarter peak level in dollars. And between them, those three countries, they make up 2/3 of the EM index. So 2/3 of the EM index comfortably above the first quarter peak. But at the other extreme, you've got countries like Colombia, Greece, Turkey, Brazil, Russia, Pakistan, which for good reasons and bad are still off between 30 and 40% from their dollar peaks. So they have significant rebound potential if risk appetite picks up or other things happen. And the same story in Frontier. You've got Mauritius down still almost 50%, almost halved from its peak level. No one's going on holiday to Mauritius at the moment. But Bangladesh and Vietnam, there's kind of Asian success stories trading at around their first quarter peak levels. You can see Nigeria disturbingly hanging in there, buoyed by a non-market clearing exchange rate, and Lebanon, a special case on the left-hand side, where equities have acted as a store of wealth during the country's banking crisis. If you look at the sectors, what you can see here is that anything tech-related is doing well and well above its first quarter peaks. So consumer durables, where you find your Alibabas and Nasdaqs, communications, where you find Tencent, IT, which has got your TSMC and Samsung, as well as healthcare for obvious reasons, all trading well above their first quarter peaks. But everything else is lagging. So particularly things like financials and the energy sector lagging quite significantly. What's been driving that outperformance of those Asian three and the other outperformers in the rebound? I think the first thing to look at is really the success at tackling COVID, which Charlie's been talking about just now. It's been very well controlled from the start in those three Asian countries, Korea, Taiwan, and China, those countries making up 2/3 of the EM index, but it's now coming down quite nicely below 100 daily cases per million across most of Latin America, and it does seem to be now quite subdued in India, Pakistan, Thailand, Turkey, South Africa, and the like. So the first driver has been success in tackling COVID, I would argue. The second driver of outperformance has been what I call the idea of fiscal firepower or resilience. And there, on this graph, which looks at 10-year local yields on the x-axis versus the change in yields on the y-axis, you can see that China, Korea, and Taiwan are firmly in the bottom left of this graph, low bond yields. The bond yields have barely moved this year, plenty of fiscal firepower to deal with the crisis. Whereas on the top right, you've got your riskier countries, your Pakistans, your Egypt and Turkey, where yields are much higher and have been rising in many cases over the course of this year. Less fiscal firepower, more fiscal stress, more risk in the eyes of investors. And then you've got your Brazils, South Africas, which during the course of this year have been flirting with the stress zone and arguably are your kind of flip countries where as risk appetite improves, those markets have scope to do a bit better. And the third driver obviously has been that tech trade, much more supportive for Asia than it has been for EMEA and Latin America over the course of this year. Looking forward, though, we think those drivers might start to change a bit. So it might become less about resilience and more about risk appetite. And why do we think that? The first reason is that flows are now starting to return. Right, the range of EM assets. Flows started to return, first of all, to EM hard currency debt. That happened as soon as April. Local currency debt followed in July. And in the last couple of months, we're starting to see money moving back into EM equities. Now, this is important as it takes off a lot of risk. It takes off the risk of debt rollover, and it allows companies to raise finance, IPOs to restart, and it makes that resilience trade less critical for emerging markets. We'd also argue that on a longer term perspective, and this looks at 10 years worth of cumulative flows into different EM assets, is that EM equities to us look pretty under-owned. Over the course of the last decade, we've seen zero net money going into emerging market equities in the last decade, and that compares with significant inflows going into emerging market fixed income and, of course, into developed market equities. Frontier there, the black line, lots of outflows over the last 5 years. Investors starting to question the asset class and wondering how much exposure they should have to that asset class because it seems to keep shrinking as more and more countries transition from Frontier back into EM in many cases. So a shrinking asset class, people questioning how much exposure they want to have over the midterm. But the major change, and a large part of Charlie's presentation was about the dollar. And what this graph shows you is almost half a century of performance of emerging market equities relative to developed markets. That's the red line. So emerging markets doing well when the red line goes up. And the dollar, the dotted black line. So the dollar strengthening when the dotted black line goes up and weakening when it goes down. And what you can see here is that emerging markets and the dollar have been almost perfectly inversely correlated for almost half a century. So when the dollar's going up, emerging markets doing badly, and vice versa. And there's been typically a 7 or 8 year cycle for 6 or 7 times that we've seen the dollar moving up and down and emerging markets doing the opposite. And we've just come out of a decade now of emerging markets underperforming against a backdrop of a reasonably strong dollar. So timing-wise, in any case, the cycle is due to change. And Charlie's given you plenty of more fundamental reasons why in a Biden presidency, particularly with potentially a split Senate, we might expect the dollar to weaken. Which emerging markets could benefit from a weaker dollar? This graph here, what we look at is the correlation and beta of different emerging markets over the last decade to a weakening dollar. And what it shows us is in the top right are those countries which are most exposed or would benefit most from a weakening dollar. It tells us to look at Central Europe, though as Charlie said, be careful of the second wave risk that we're seeing in Central Europe at the moment, as well as Latin America, Brazil, Colombia, to an extent Mexico, should all benefit from a weakening dollar, as well as South Africa. You've got China, Taiwan, and Korea somewhere in the middle, so still okay if you like those countries. But what you want to avoid if you think the dollar is going to weaken is the currency-pegged Gulf countries, Saudi Arabia, Qatar, and Kuwait, and also Bangladesh, Sri Lanka, and Pakistan, where currencies tend to be a bit more dollar-pegged typically. The same graph, but looking at sectors, tells us that if the dollar is going to weaken, you might want to look again at the banks and the materials names, potentially real estate as well, if you think we're ever going to go back to the office. A quick review of where we are on valuations. You've seen a an equity re-rating globally for two reasons. Firstly, because there's been money coming into equities on a global basis, but secondly, because you've got a bit of a shortfall in terms of earnings. So you're not necessarily looking at a full earnings recovery when you look at 12-month forward PE at the moment. The most pronounced re-rating you've seen versus the 10-year average, which we look at here in this graph, is in China and the US. But you've seen the least re-rating globally in Latin America and EMEA. So perhaps the greatest catch-up potential in terms of valuation still there in Latin America and EMEA. You've got emerging markets versus, when you look at emerging markets versus developed markets at the valuation, emerging markets at the moment trading about 27% cheap versus developed markets, not far from the levels from which it typically rebounds, about 0.6 standard deviations cheap versus the 10-year average. Frontier versus emerging markets, only 12% cheap. You might say nothing special, but what we'd point out here is that Kuwait is about to leave the Frontier Index and transition back to emerging markets at the end of November. Kuwait is 36% of the Frontier Index, and when that comes out, we reckon that the PE of frontier markets will reset downwards from 13 times to 10.9 times, and that will widen the discount of frontier to emerging markets out to 26%, which would be a decade high. So frontier markets, once Kuwait comes out, looking pretty cheap again. Versus the 10-year average here, you've got relatively few emerging markets looking cheap versus the 10-year average, but a few of them do. Malaysia, Mexico, the Czech Republic, South Africa, Colombia, Hungary, Egypt, Pakistan, and Turkey, all looking relatively cheap versus their 10-year average PE. And in sector terms, it's real estate, financials, utilities, and the commodity space where the value still seems to be. With Charlie talking about the global search for yield, I think this slide is particularly important and worth spending a bit of time on here. What we have here on the bars is the 12-month forward dividend yield across different emerging markets. The blue diamonds are the 10-year bond yields, and the black diamonds are what you get on one-year deposits in different emerging markets. And why this is important is that we think the Fed, as well as the ECB and the Bank of Japan, are going to be super dovish for the foreseeable future, and that's going to fuel the search for yield globally. And it already is. And what this is now showing us is that the dividend yield is now higher than the local 10-year bond yield in over half of emerging market countries. And that's very important as we think that's going to draw demand from international investors seeking income into emerging market equities, as well as, importantly, from local investors. And particularly if the dollar does indeed weaken and emerging market currencies end up being supported, those yields suddenly become much more attractive to dollar investors. So today we've got 14 emerging market countries with a dividend yield higher than the bond yield. That compares with just 7 5 years ago and just 3 with a slightly smaller sample back a decade ago in 2010. If you want to look at the rates locals can get on their time deposits, that 14 emerging markets with a dividend yield higher than the bond yield actually expands, and you have 17 emerging markets where the dividend yield is higher than the rates locals can get on their time deposits. And we think that's going to fuel a virtuous circle of local investors taking money out of their bank deposits and putting it into either bonds or increasingly equities right across many of the emerging markets that we look at here in this graph. We can also see here, this looks at the last 10 years, that it's those countries where the dividend yield has tended to be relatively high versus the local bond yields, which have tended to outperform over the medium term. So we think that dividend yield story is likely to be quite supportive across emerging markets over the next decade. A few graphs to wrap up. Here we look at the rebound in growth, what the IMF is expecting in terms of the growth rebound across emerging markets next year. That's usually a more important driver we found than and what it's suggesting is that the kind of steady as you go safe havens, those Koreas, Taiwans and Chinas, will rebound. They'll have quite decent rebounds, but the big rebounds are going to be somewhere else. They're going to be in countries like Peru, India, the Philippines, Malaysia and Mexico. So perhaps a bit of a shift of emphasis here. Emerging market investors are likely, we think, to be looking at those growth rebound stories increasingly over the next few months. In Frontier, it looks like those tourist destinations, Mauritius, Croatia, Slovenia, Morocco, Tunisia, and Sri Lanka, could be leading the growth rebound. So we need to watch out very much for the risk of a second wave, and whether we get some kind of tourism-enabling vaccine or widespread testing regime, which will allow tourists to go back to those countries on the left-hand side of the graph, which could benefit from a return to tourism flows. On commodities, as Charlie mentioned, very important graph here that as the renminbi starts to appreciate, as the IMF expects it will do gradually over the next few years, the dollar GDP being created annually by the Asian emerging markets is likely to be back well above the 2010 peak over the coming years, which should generally be supportive, we think, for commodities, notwithstanding the long-term aims of reducing carbon emissions. So to wrap up, what do we think on the equity front? Firstly, dollar weakness and emerging market equity strength go hand in hand over almost 50 years. There's historically been a 7 to 8 year cycle here. We're now a decade into the dollar strengthening EM underperforming cycle, so we're overdue a change. A split Senate could be quite good for EM here, as it implies more emphasis on monetary stimulus over fiscal stimulus in the US, thus pointing, we think, perhaps to a weaker dollar and an ongoing search for yield. The second point, dividend yields are now exceeding local bond yields in over half of emerging markets here. Dividend yields are exceeding term deposits in 2/3 of EM, and we think that's going to trigger a wave of buying by local investors of equity markets across EM. The third point is lackluster flows into emerging markets with no inflows for a decade into emerging market equities suggests to us a potential for significant reallocation from international investors into emerging markets on the back of a normalization of trade rhetoric and perhaps a weaker dollar. The fourth point, if we do get a weaker dollar, it suggests that investors may seek to move up the risk curve, perhaps rotating out of those Asian safe havens towards some of the cheaper currencies in Latin America and EMEA, and the financial sector and commodity sectors could do better within EM. The fifth point, a stronger renminbi should bring strong dollar GDP creation to China and its Asian peers, supporting the commodity sector. And the sixth and final point, Frontier equity is now looking particularly cheap once Q8 transitions out at the end of November, trading at a 10-year record valuation discount versus EM. I'll wrap up here. We're very happy to answer any of your questions, so I'll stop sharing my screen and return so you have Charlie and me for any Q&A.
That was really interesting, Dan. I enjoyed that. The lack of inflows into EM for the last 10 years interested me because it reminded me of one thing I forgot to mention, which was we've been looking at currency analysis and per capita GDP in dollar terms, and only about 30 countries have outperformed the US in terms of dollar per capita GDP growth. So I can understand why people have been favoring US equities. The countries that are really underperformed on dollar per capita GDP were primarily the resource exporting emerging markets. And that showed up also in your chart on the materials and so on that were looking, and the resources that were looking cheap, which just suggests to me that we've had a tough 10 years in that space. A lot of bad news is priced in, and we all understand the reasons why, as you always do when the market's near its bottom, or perhaps at its bottom. But I can see it. There's quite a lot of factors here, whether it's the currency, whether it's equity valuation, whether it's flows to EM, all of which points to an asset class that's been not favoured for a very long time. And I think there's quite a decent scope for a rebound here. That was cool. If there are any questions, and it doesn't look like there are, I'll give it just a couple more seconds. But otherwise, thank you very much for tuning in, for spending the time to look at our presentations. They will be available. We can email them to you. And best of luck. I do hope we're right that the 2020s prove so much better for emerging market investors and the people who live in them. Thanks very much for your time. Take care.
Out of context, facts and figures can easily mislead. Is Africa's growing population a weakness? What about tomorrow? Don't get boxed in by today's opinions. With the Africa Report, understand Africa's tomorrow today. Politics, business, opinion, the Africa Report decodes the news for you. Available online on theafricareport.com.